All right, back to Expandable with another episode. This one I want to be informative and practical for a business owner that has had a good year this year, and they're looking ahead to next year. I mean, it could be during the middle of the year too, but they're looking ahead at their businesses and they're saying, hey, we're doing well and we think we have the capacity to grow and we have these orders coming in, or these vendor relationships, or whatever the scenario is in their type of business that they're going to expand. And we are looking at maybe, upgrading our building, buying a building because we're renting now, or something to that degree. Or maybe they have multiple locations and they want to expand in a different way. And, potentially even ended up on our commercial loans page on our website, and they're looking for help on how, what's the process look like? Like if they were to say, hey, in 3 months, 6 months, we want to expand, and we come to Surety to do that, help them understand, like, what should they be thinking about in context to that whole process?
First you want to think about the documents that are going to be gathered.
Okay.
And, it's amazing, but it really just goes back to the absolute basics. When you're looking to borrow money, of course, they're going to look at how well you have done in the past. So how do you do that?
Okay.
Tax returns.
Sure. Okay.
So that's number one. So you're end of the year, you want to file your tax returns as soon as possible. And yes, it is fine to file an extension. But if you've been in business for a couple of years and now you're looking for a loan in March and April, and you don't have tax returns, you file an extension, which is all legal. You show the extension, you paid your estimated taxes, but still, you don't have your tax returns. File your tax returns. Get it done. Okay. Because that is telling the bank right off the bat that you're up to date on your stuff. Because I don't know about you.
Yeah.
I mean, I don't believe I've ever filed an extension. Maybe one. No, I filed an extension one time, and I hated it because I thought about it every single moment. Mind, yeah. Yes.
It's a loose end.
Get it done as quickly as possible.
Okay.
And especially, you're going to file out, have your tax returns done.
Yeah.
And then, of course, a financial statement is what is going to be asked of. You're going to want to see a balance sheet and profit and loss on your company.
Gotcha.
So you've got balance sheets that are embedding tax returns. Now, that's going to be a little bit different sometimes than what your internal balance sheet are. So when they are different, you need to know exactly why. Okay. Maybe depreciation hit here, you max out depreciation here. So your tax returns are going to show the minus depreciation, but, did the value of your collateral really depreciate for your overall current asset? No. So you need to know those differences. Mm-hmm. And also we're going to ask for your end of the year profit and loss. You wouldn't believe how many times you would have internal numbers have gross sales of 3 million, and then you look at the tax returns, their gross sales are 2 million.
Yeah.
Right off the bat. Why is that?
Yeah.
I mean, because you're going to lead and the underwriter's going to be like, okay, they're lying on their taxes.
Right.
So, I mean, don't do that.
Right.
You're looking to borrow money from a federally insured bank.
Mm-hmm.
And, everybody's got, and banks aren't going to loan you money unless they can cash flow.
Right.
And the way they verify cash flow are tax returns.
Yep.
Not going to be on an internally prepared, oh yeah, I made this, but I only paid taxes on this.
Or we're just trusting that you.
Correct.
Yeah.
If you want to go that route, you're going to go private money and you're going to pay a lot more. But if you want to go to the, legitimate route, mm-hmm. just have it simple. And when you fill out your personal financial statement and ask for liquidity, that's how much cash your bank snaps. Just go ahead and pull out your bank statement and say, you know what? I'm going to have this as of January 31st because my ending balance of my account was X.
Yeah.
Boom. It matches.
Mm-hmm.
So you wouldn't believe, when my underwriters, as soon as they get and stuff, you look at the personal financial statement. Oh, they didn't sign it where it says sign. I mean,
the little things.
Yeah. Just that. If you have a question internally, have that. Oh, what is it? And there's still stupid questions on there.
Yeah.
Asset categories that you may know nothing about. That's fine.
Mm-hmm.
That's fine.
Have that conversation later, but just fill in all the information.
Yeah. And just make sure it's accurate. Okay. If you have $50,000 in cash, show that you have 50,000.
Right.
We're not. Just have it make sense and have it be real and be prepared. You're going to have, tax returns that you're going to have to deliver.
Yeah.
Full tax returns. Don't send a front page.
Yeah.
It means nothing. Full tax returns, personal and business tax returns.
Okay.
And when you fill out the personal financial statement, all the banks are going to have you fill out that. You haven't been in long enough, probably where the business is going to support itself. They're always going to look at personal guarantees as well. Fill it out accurate into the belief and have it match your bank statements.
Got it.
Simple.
Good. Okay.
That right off there, you start off on a great note.
Yeah.
Now it's honesty, because a lot of times people just, they know, I got 40,000, and then the bank statement showed 20,000. Well, where is it? Oh, it's in this other bank. Okay. Well, you know.
Yeah. So tie up all the loose ends, do all the little kind of work to get it all clear. So it's a clear picture for the banker.
Correct.
Yeah. And then once you get into the conversation, you start the process, you start with an application, you're referring to that, making sure that, all your I's are dotted.
That it coincides, I mean, we get applications that they don't even put how much they want to borrow on. It's like, okay.
It's like, and I get it to some extent, some people will not, it's almost like, not that they don't know to put the information there, but it's almost like that's their way of starting the conversation. And I think that's what this video is for, is like, let us help you.
But
let's cut a lot of that out.
Yeah. I mean, but look it up. I mean, in this day and age, if you don't Google something that takes 2 seconds, let's face it. Why as an underwriter, then it's going to be difficulty.
Yeah. We need the data.
Our relationship doesn't end once the loan is closed.
Right. It's almost really just starting.
It is.
Yeah.
And banks don't make their money right off the bat. It's years of paying that payment. We look over the course of years,
right?
Not that first initial. We have a lot of upfront cost with staff, and then it reduces. But we still deal with it over years, especially larger loans. You're collecting annual insurance. You're collecting additional financial statements every year, because we still monitor the business. And we have to monitor because, if that business is deteriorating, we need to know whether or not we need to reserve additional requirements.
Yeah.
And put money aside because, okay, this industry sector, and maybe it's just that individual company, or maybe it's a sign of that industry. And then we look at the rest of our loans that are associated with that industry. So it's a constant monitoring of our assets. It's an asset. Once we loan it money to you, that is on our books as an asset and collection, and we monitor it throughout the life and look at credit reviews.
Yeah. Yeah. And it's got to be a good, solid relationship that you're kind of stepping into once everything is funded. But starting at the very beginning, then putting their best foot forward and having all the information that they can potentially have clean, data.
And 100% and correlate the people that send you the tax returns and everything in an orderly structure area typically pay their bills a whole lot better than just piecemeal.
It shows to you that they're organized.
Yes.
Yeah.
It's simple things like that.
Yeah.
I mean, because, and especially, if we get emailed, don't email, we have secure links to upload everything. We want to have it securely. But when we get a PDF uploaded and page 3 is upside down, tell me that's not going to, that's time involved for staff to flip it around. You have errors.
Which is, you can do. It's not like you don't have the capability of flipping around, but it's starting the process of painting a picture of the total, because you talk about this 4 C's or whatever, like character of the person.
Yes.
It's like, if you're not organized with your finances, then it's a good picture into the rest of your business. And,
correct.
And what
then too, it lets us know, okay, you're watching it. So if something, the ebb and flow of any business is going to go up and down. There's going to be times, but then it let us know that, okay, if you're having a lull, you're apparent to it, you see it, and you make changes. That's who you want to do business with.
It's true. Yeah. I like it. So let's say, they've filled out the application. It's pristine. Everything's in. It's organized and clean. Then what happens after that?
Okay. Typical rule of thumb on commercial real estate financing is typically 70% of purchase value or appraised value, whichever is less. So even if you want to purchase it for $1 million, if appraised at 900, you're going to look at 70% of 900. You have to come up with the extra. typically most of the times it's not going to be that different, if anything, but in general. There are exceptions. Owner occupied, yes, we can go up to 85% loan to value on the purchase. And even if it's not owner occupied, meaning the owner of the business is going to be in that location and fill out majority of that commercial real estate.
Okay.
So that is the typical rule of thumb. And then for debt service coverage is typically 1.25. So what that means is if you have $100,000 in payments, principal and interest, that your net cash flow is in excess of $125,000.
Gotcha. Okay. And then, so once the application is submitted, they understand kind of the initial terms of what they should be expecting. Then they'll get an email, or they'll get reached out by a
What
banker.
we do,
and then how do you start that process?
Yeah. So, I mean, right in the beginning, we're having discussions with them, talking about the loans, looking at the tax returns, looking at the financials. Where do they want to go? What are they going to do with the proceeds? Is it just build this location? Why is this location going to improve? And so we build a case, positive or negative for it. So we're part of that process with them, and they'll get a commitment letter, and the commitment letter is going to outline costs, if there is any points associated with it, doc preparation fees, we're in Florida, so we don't have state income tax. So there's going to be other things that, maybe out of state people don't realize you're going to have doc stamps and tangible tax. And so we will level that in a commitment letter, have you review it all, and that'll be there.
And then once they sign and everybody's signed up.
After you sign, then it's usually contingent upon appraisal. So you got to put up the money for appraisal, then that time frame. So, appraisal, survey, you're going to do inspections on the property. That's up to you. We're going to look at those inspections too and make sure it's not,
there's no red flags.
That it deteriorate the property. And, we don't want you to get into $1 million property and then, the inspection occurs and you've got no use of it. Now you need an extra $200,000 to, get it back up to par, maybe AC's out or roof or whatever.
Right. So what happens in a situation like that? Someone in this scenario may already be looking at property, and now they're kind of taking a step back to look at the financing part, and they already know, well, I'm looking at these 3 properties, and one of them, you can get it for a little bit cheaper, but it's got a lot of repairs. How should they be thinking about those repairs on the front end before the inspection comes back and shows all these red flags? I mean, should they be thinking about that?
So, I mean, in typical, the value should reflect the age of the building too. Okay. I mean, if it's not a brand new construction, you don't have, 30 years on the roof. Maybe you got 5 years left on the roof and you want to go and replace it, or the AC's completely shot and you want to rebuild that. We can build that into the cost. Like I said, it's cost or appraised value. So a lot of times, so you're buying it for $1 million, you need $200,000 into it. Once this $200,000 are into it, complete it, maybe it's really worth $1.25 million. Then we'd be looking at, okay, theoretically you bought it for $1 million, you have $200,000 costs. We're going to look at the value of the property as 1.2 once completed and look at a percentage of that 1.2.
Gotcha. Okay. That's good.
So then it's not like, we're doing $1 million property. We have $300,000 down to 70%. We need $200,000 now. We need another $200,000 cash. No, you'd be looking at, 1.2, 70% of them 1.2, which, extra 140, 700, 840,000. So you got a loan, you come up with the rest.
Nice. I like it. I think that kind of does it for the person looking for those major.
And I got to caution,
points,
people always, when people want to borrow the max capacity of that, 90% or 100% of that real estate, don't. You put yourself in such a bad situation that if anything does happen, you've got no equity to bail yourself out on it.
That's right. Yeah.
Just don't.
Yeah. So, and I sort of see the theme of this is like kind of get all your ducks in a row in your business. Obviously on the financial side, but you have to do a lot of planning to come up with that extra cash and have that buffer and make a smart decision. Not just that. And we're not necessarily here right now.
Yeah. You want to build on stuff. You don't want to have to constantly go back.
Yeah.
Yeah.
So making smart decisions.
Because look, the last 20 years, money has been so cheap out there that people have businesses have the worst habits now as far as borrowing. I mean, the amount of people that I have seen get $1 million idle loans from the government at 3%, just like, oh, cheap money over the last few years. They've already blown that money, but they're still going to have to pay that $1 million back. So regardless of 3% or not,
right?
Companies now that are having to borrow even after they spent that money 2 years ago.
Yeah.
And your sales should have been fantastic. And most every industry has been great over the last several years. Granted, you had a time frame pandemic and where you were and relationship in the U.S., but a lot of businesses have done well, and a lot of shitty businesses have really done very well, and they're not going to do well anymore.
Yeah. I can see that. I've seen that too in the market. This is good. Okay, great. I think this is a great kind of kickstart for somebody who's looking to expand from a practical standpoint. And I guess if you're watching this, feel free to reach out and get in touch and ask us questions about getting started.
Yeah. Thanks.